So that's point number one. Why do you exist and why should they care? So
DeWayne, thanks so much for coming back on the pod.
yeah, thanks. I appreciate being on again. This is great.
First off, congrats. You guys at Versor just raised $500 million for your event-driven strategy. How does it feel?
Feels good. It's certainly these things are never easy. So it's never easy to raise capital, but it's certainly great to get a win. All right.
Yeah, never easy. I'm just curious how it worked. What was the first step?
Yeah. So we have this event-driven strategy we launched in about 2.5 years ago. The first step was really canvassing the universe around folks who can act quickly. A strategy that only has 2.5 years of track record isn't for everybody. So it's really the first step is identifying a universe of investors that we thought could act pretty quickly. Where we settled on was focusing on people who would allocate through managed accounts. And the world of managed accounts has certainly morphed. And historically, that had been like the fund-of-fund community. As of late, and this is a pretty recent phenomenon, we're finding other hedge funds. So multi-strategy hedge funds have been increasingly allocating managed accounts in order to get access to talented managers. That's a new area that's really morphing into where historically the fund of funds used to play. There is this hybridization going on between what is a fund of fund and what's a multi-manager. But that was where we really focused on at the outset.
And so you've identified the funds that you think would be interested in this event-driven strategy. I guess, how do you approach them? What does that whole process like? And I asked that question with a context of, maybe someone in our audience one day would like to raise, call it $500 million, a big chunk of money from a big multi-manager, say like a Citadel or a Millennium. I'm not sure if Citadel does external allocations, but what was that like? What was step one of actually approaching multi-manager funds?
Yeah. You framed that question interesting and from the perspective of someone wanting to raise the first dollar or first $100 million. I think this doesn't apply necessarily just to sourcing capital for multi-managers, but from anywhere. I think an investment manager needs to ask themselves the existential question, why should people care? So what is it about you that's different than the thousands of other men and women that are seeking capital in the world? So existential question, why should people care? As it relates to multi-managers, I think it's having an understanding of existing exposures within the multi-manager ecosystem. A lot of multi-managers are focused on equities, whether that's quantitative or fundamental, whether that's long short with some sort of net exposure or some sort of equity market neutral stat arb type exposure. That seems to be the lion's share of a lot of multi-managers' allocation. So to the extent they're allocating outside of what they have in-house, the objective is to find something that's additive, perhaps diversifying to existing exposure. So that's point number one. Why do you exist and why should they care? And that was big for us to really, with the event-driven strategy, and I'm happy to describe in a little bit more detail, is describing how that is fundamentally complementary to what they have and why we exist and why should our process warrant an allocation from a group of managers who have access to almost every strategy in the world.
I see. And so, you mentioned there the lion's share and the biggest chunk of allocation of the multi-strats is these stat arb strategies. And so you guys come along, you have an event-driven strategy. I guess you asked yourself that question and you said, okay, because this thing has our strategy in particular provides a differentiated return stream. I'm imagining that, and you can correct me if I'm wrong. And then you go to pitch a bunch of the different multi-strats. What sort of questions are they asking?
Yeah. So the big part of what the multi-strats are focused on are kind of risk-return characteristics. And a lot of them have these sharp thresholds. A lot of folks that say that I'm not going to allocate to anything that has a Sharpe ratio less than 1.5, maybe a Sharpe ratio less than 2, somewhere thereabouts. What they're really focused on is preserving capital and maximizing returns. So a lot of questions they ask are around how do you go about generating returns? So what are the forecast models? What are the inputs? And asking questions around how can this process be repeated in the future? So what about your process and what about your implementation is something I can expect a high risk-adjusted return going forward? So that's fundamentally a big part of what they ask. The other thing they want to understand is around the team structure and dynamic. Like, who are the folks that are looking after building these strategies? What's the experience level of the men and women involved? How are they differentiated versus some of the other folks? Again, going back to what I initially saying, how this is differentiating versus some of the other things they already have in their portfolio, already have access to.
How do you know how to answer those questions when you don't actually know all the different strategies they're running? I mean, these funds are famously super secretive. One of my podcast guests who worked at Millennium even told me that he didn't actually even know how well the fund was performing. The way he'd see it is from the news. So you guys, you don't know what strategies they're running. You know that the bulk of what they're running is maybe stat arb and maybe less something of the event-driven sort. But how do you sell to them without that information and without knowing that piece of the puzzle?
Yeah, I think, we didn't describe Versor at all. In addition to the event-driven strategy, we do some things in the stat arb space. We'll invest in the future space. At our core, we're a quantitative multi-strategy firm, not a multi-strategy fund. One of the benefits of having exposures and participating in various aspects of kind of the hedge fund ecosystem is that we generate streams of returns or risk analytics to help us understand common exposures across various hedge fund strategies. Oftentimes people refer to these as factor exposures, right? So while I may not know exactly what Millennium or Citadel own in-house, I do have an appreciation of common hedge fund factors. And everybody has exposure to things like value, momentum, quality across either equities or futures. Now, if I can fully understand kind of these common exposures that are prevalent in hedge fund space, in the same way that equity beta is common in the traditional long short or the long only space, then I can have a conversation around how is this implementation different than these common hedge fund exposures, right? How are we uncorrelated to, say, the value factor or momentum factor? Now, I don't know how much value or momentum that each of these managers might own, but I know they have something. And I know that most of these folks are seeking return streams. They're not common. So if I can articulate that through kind of quantitative rigor and analysis, that this return stream, what we're doing in the event-driven space, is truly different than these common factors, these common exposures, then we can have a dialogue around how are you different? What is the process that makes you different? And how is this implementation truly complementary to some of the other things I have?
Let's say I'm Izzy Englander and I'm sitting in front of you right now. And I say, great to meet you, DeWayne. Love to hear about your strategy. What makes it differentiated? What makes it different? Why do we need it in our portfolio?
Yeah, so if you're Izzy, I don't know if Izzy would ask that question directly.
it's hypothetical.
Yeah. So I think that goes into me describing kind of the implementation. So the event-driven strategy traditionally is thought of as a discretionary strategy, where there is a man or woman who is evaluating hard catalyst events, maybe it's a merger, arbitrage transaction, maybe it's a spinoff or other announced or corporate event, and doing kind of deep fundamental analysis and understand the aspects of a trade and understanding the aspects of it in any given deal. Maybe they're having a conversation with management. Maybe they're having a conversation with other influencers on the street, folks at banks and research analysts. Our implementation is taking that approach, taking the approach of a fundamental analyst, a fundamental researcher, and quantifying that and creating a systematic process around that. So what that allows us to do. So we'll take what we've done in order to develop that process is examine every announced hard catalyst event in North America, Europe, Japan, and Australia, going back to the last 26 years. So by analyzing this data set, we ask ourselves some initial questions. So what are the problems that I'm seeking to solve? If I use M&A as an example transaction and merger arbitrage, some of the questions that you're seeking to solve are, is this deal going to happen or not? If it happens, is it going to happen at the price that's stated, or will there be some upside? If this deal fails, how much am I going to lose? Am I going to lose that it's going to go back to the original price, or is going to be some deviation away from that? So we're asking ourselves a series of questions. The next step for what we do is then we've asked these questions. We want to curate data. So the data creation is creating this database. That's a painstaking process. You can't buy an off-the-shelf merger arbitrage database. You have to go out and source the data. So it's going back and looking at fundamental data, looking at market data, looking at alternative data. Alternative data is news and events, things that don't fit in nice, neat rows and tables across the entire universe. So once you have this data set, the next step is, all right, I still need to answer this initial question. What are the features within this data that helps me answer the question? Some things are somewhat obvious. When people evaluate a merger deal, they'll oftentimes look at deal spread. But deal spread at announcement doesn't really give you a good picture of whether or not this deal is going to happen or not. There are things that are obvious. If a deal's domiciled in Europe, it fails at a much higher rate than the U.S. What's the debt loading of the transaction? How much of the company does the acquirer own at announcement? And some other features. I'm just naming some of the obvious features, but there are thousands of these features. And from these features, we're able to train models. So we build models that are seeking to answer the questions that I stated at the outset. What this systematic process allows us to do is, one, get in and out of deals much more efficiently. Identify deals that we want to invest in or not invest in much more efficiently. It allows us to have much more diversification. The work it takes our models to look at a $1 billion transaction is the exact same it takes us to look at a $10 billion transaction. In fact, we would much rather have $10 billion transaction than one $10 billion transaction. So the diversification bit is quite important. And the last aspect, and I think this is quite important to multi-managers and folks that are concerned about market risk, beta in particular, is we can train models to understand the dynamics of any given transaction, how a particular deal behaves in various market regimes, and really understanding volatility of individual deals, understanding the correlation structure of individual deals, and increasing and decreasing exposures in real time as market dynamics change. While that last point is important, is that what we're really focused on in kind of this dynamic increasing or decreasing exposure is managing for beta and really reducing exposure to risk that we don't want to own. We want to own the risk of whether that deal is going to happen or not. We don't want to own the risk of the variance of the markets at all.